For a long time, a bad quarter inside U.S. boardrooms had a clear definition. Revenue missed expectations. Margins declined. Growth slowed. When those numbers turned negative, alarms went off. Management faced pressure. Explanations were demanded, and strategy was questioned. In 2026, that definition is changing. Boardrooms across corporate America are quietly redefining what a bad quarter actually means, and the shift reflects how risk, volatility, and performance are now understood. The most important change is context. In the past, quarterly results were evaluated against relatively stable assumptions. Demand patterns were predictable. Costs moved gradually. Guidance held for long stretches. Today, conditions change constantly. Inflation, interest rates, regulation, supply chains, and technology all shift within short time frames. As a result, boards are less focused on whether a quarter hit every target and more focused on whether outcomes make sense given the environment. A bad quarter is no longer automatically one with slower growth. Instead, boards ask different questions. Did the company protect margins under pressure? Did it preserve cash flow? Did it avoid taking on unnecessary risk? In many cases, flat or modest growth is viewed positively if it reflects discipline rather than weakness. Stability has gained value relative to speed. Execution quality has become a central metric. Boards are paying closer attention to how results were achieved, not just what the results were. A quarter with lower revenue but strong execution, controlled costs, and operational clarity may be viewed as healthier than a high-growth quarter driven by discounts, overextension, or fragile assumptions. The path matters as much as the outcome. Forecast accuracy also plays a larger role in defining a bad quarter. Missing a target by a wide margin is now often seen as a planning failure rather than a performance failure. Boards are increasingly concerned with predictability. A company that slightly underperforms but forecasts accurately builds trust. A company that swings wildly, even with strong top-line growth, raises concern. Cash flow has moved to the forefront of boardroom evaluation. In earlier periods, companies could tolerate temporary cash burn in pursuit of growth. In 2026, cash discipline signals resilience. A quarter that preserves liquidity and strengthens the balance sheet is rarely labeled bad, even if revenue growth slows. Conversely, strong sales paired with deteriorating cash flow raise red flags. Risk exposure has become another defining factor. Boards now evaluate whether a quarter increased or reduced vulnerability. Did the company take on long-term commitments that assume favorable conditions? Did it expand exposure to regulatory, supply chain, or financing risk? A quarter that avoids new fragility may be viewed favorably, even if headline numbers disappoint. Cost management has also been reframed. Aggressive cost cuts used to signal trouble. Today, controlled cost adjustment often signals competence. Boards distinguish between strategic cost discipline and reactive cuts. A quarter that shows thoughtful expense control without damaging core capabilities is often seen as responsible rather than weak. Market behavior has influenced this shift as well. Investors have become less forgiving of volatility and more skeptical of aggressive promises. Boards understand that credibility matters. Overreacting to a single quarter can damage long-term confidence. Redefining what counts as bad allows leadership to stay focused rather than reactive. Another factor is the normalization of volatility. After years of disruption, boards recognize that uneven performance does not necessarily indicate decline. They expect variability. What concerns them is trend, not noise. One uneven quarter is acceptable. Repeated signals of deteriorating fundamentals are not. The definition of bad has shifted from short-term deviation to sustained weakness. Internal metrics now play a bigger role than external benchmarks. Boards rely more on operational indicators such as customer retention, backlog quality, pricing power, and execution timelines. These signals often tell a clearer story than headline revenue numbers. A quarter may look weak externally, but strong internally. Strategic positioning also matters more. Boards ask whether the company is better positioned at the end of the quarter than at the beginning. Did it gain flexibility? Reduce dependency? Improve resilience? If the answer is yes, the quarter is rarely labeled a failure. This shift also reflects lessons learned from overreaction in the past. Companies that chased short-term optics often sacrificed long-term health. Boards are trying to avoid repeating that mistake. Redefining bad quarters helps prevent decisions driven by fear rather than strategy. Importantly, this does not mean accountability has disappeared. Performance still matters, but evaluation is more nuanced. Boards separate controllable execution from uncontrollable conditions. Management is judged on decisions, not just outcomes. Why boardrooms are redefining what a bad quarter means ultimately comes down to realism. The business environment no longer rewards rigid expectations. It rewards adaptability, discipline, and consistency under pressure. In 2026, a bad quarter is not one where growth slows. It is one where risk increases unnecessarily, visibility declines, or execution deteriorates. That distinction changes how companies operate, plan, and communicate. This new definition encourages better behavior. Leaders focus on building durable businesses rather than chasing quarterly perfection. Boards focus on long-term viability rather than short-term optics. The result is a quieter but more resilient form of corporate performance. Fewer dramatic swings, fewer reactive decisions, more emphasis on sustainability. In a world defined by uncertainty, redefining failure is not lowering standards. It is aligning standards with reality. And for U.S. companies navigating constant change, that shift may be one of the most important governance changes of the decade.